little bit about me before we get started. I'm the managing partner of Rehab Wallet, which is the lending arm of PassiveInvesting.com. I'm sure a lot of you know about PassiveInvesting.com, but we're going to go into that a little bit. And and when I talk about we, I'm going to while I am only the partner in the lending arm, I feel, and the whole team feels as one with PassiveInvesting.com. In addition to that, I'm an investor in all of the arms of their business. So I 100% feel connected and a partner with PassiveInvesting.com. So I am the managing partner of Rehab Wallet, which is a lending arm. They have 5 arms of their business, which is 1, multifamily, of course, also storage, car wash, hotels, and lending. So we're going to go into that as to why lending and why lending became their alternative asset class. But I have 2 decades of experience in the lending business. And again, just like I spoke about, I am a real estate investor. I'm a limited partner and a co-GP inside a lot of the deals at PassiveInvesting.com. But I flipped for over 18 years. And I used lending, hard money along the way. So when we started Rehab Wallet, which is the brand of the lending arm, we actually started Rehab Wallet through the lens of a flipper, which was me. My job of the partnership is to ensure that the money, that capital that was raised, gets put into good loans and gets put on the street. Okay, so that's a little bit about me. I'm going to jump into a little bit, but how PassiveInvesting.com uses a debt fund and why lending. So lending at Rehab Wallet is very short term. We do 6 months to 9 month loans. We like the same, in this example, $100,000 that we lend out. We like to use that 2 times in a year to make fees on, to ensure, to give good loan to our borrowers, and to have money to lend out to our borrowers. So why lending? It's a short-term income stream for our investors and our partners and GPs. So in this example for multifamily, as we all know, if we're in multifamily deals, or you're a GP or co-GP in a multifamily deal, you know, you get paid at the very beginning, right? You get an acquisition fee, a management fee of some sort at the beginning, and then you got to wait sometimes until you refinance or sell 5 to 7 years until sometimes you get paid again. So this alternative lending arm, which is lending, it's our short-term income. We've always felt as partners that we all need short-term, mid-term, and long-term income streams to feed our families, to get into deals, to to do whatever you want to with the income that you make as a GP. So lending is a short-term income stream, and it kind of balances out this weight of income coming into the GPs. Another thing why lending, that we use lending or use our debt fund for lending, is that it kind of keeps our money compounding instead of sitting. You know, any money in a bank is dead money, right? And so we want to make sure that that we can use any money that we might have that might be sitting in between apartment deals or multifamily deals, or in between car washes, or in between storage deals, that we have that money sitting in our fund and we can use that to lend out. So it's not dead. On the lending side, why lending? Lending is a great alternative asset class because it brings great returns, not only to our investors, but also to the partners and to the employees. So you can make upwards of 15% APR on any money that you might want to passively invest or private lend during the time that your money might be sitting. So let's go through an example real quick. If you had $100,000 that you wanted to lend out in between multifamily deals, you might lend it out at 13%. and you will make 2 points, 2 origination points, and a lender fee. So 13% annually, plus 2 points, plus a lender fee, which equates to about 1% at Rehab Wallet. That's where I get 15%. Now, again, in our example, if I can take that same $100,000 and lend that same $100,000 out twice in a year, now I can make way more than 15%. I can make those same 2 points and the same lender fee on the same $100,000. So now we're upwards of 18% APR. So that's not always the case, because not every loan comes back in exactly at 6 months. Sometimes it's 7 months, sometimes it's 9 months, sometimes it's longer. But you also have loans that we close today that might come back in 2 months. So it's just a good place that you can actually make great returns on money that in other instances, it would just be sitting and not doing anything, or paying very little interest on your money while it's sitting in the bank. So that's what PassiveInvesting.com has decided to use its debt fund. Now, what is a debt fund? Our debt fund pays fixed income to our investors, meaning it's the same amount month after month, year after year. We decided to start with a 6% income to our investors. Since rates started increasing, we've actually had a change in our metrics to be able to say the more money you bring in to the debt fund, the more interest you make. So it's tiered now. So somebody bringing in 25,000 might make 6%, but somebody bringing in 2 million can make upwards to 8.5% or more. We pay our distributions monthly. So in this exact example that I've been telling you about is $100,000. If you invest $100,000 in our debt fund, we pay out 6%, which equates to about 0.5 point a month. So that's $500 a month. And we pay that out monthly. We also have a compounding feature that you can add to your debt fund that's very unique. And a lot of our investors really like this. So in our example here, $100,000 makes $500 a month. You can leave that $500 out in the fund, not accept your distribution. And now your money in month 2 is compounded at $100,500. So it has a compounding feature month after month after month that makes this 6% turn into close to double digits if you keep the money in there for a longer term and consistently keep your distributions inside the fund and let it compound. We decided to use a 506c fund for solicitation because, as we all know, PassiveInvesting.com has a big marketing arm and a marketing department. So we want to be able to solicit this debt fund out to the masses. So we've chose to use the 506 feature of solicitation with the SEC. Now let's jump into the lending piece. Okay. So again, our fifth arm at PassiveInvesting.com is lending. So let's talk about the 5 pillars of lending really quick. The first piece of the whole the whole thing, the whole debt fund, the whole play is that we got to raise the capital. So you raise the capital, and now we have the capital in the fund, and now we need to start originating deals and get the money out of our escrow account and into the operating account and get it to work, right? And so that investors start getting paid. Now we have chosen to raise money, and the investors' money is collateralized over all of our deals. Some people use a debt fund, and for instance here, if you have a $150,000 loan request come in, you then go out, solicit to an investor, and investor A comes in and puts $150,000 into the debt fund, and that $150,000 goes to 123 Main Street, and it's connected. That's not the way we choose to do it. We choose to raise money, and our investors' money is collateralized. It definitely reduces the risk. It's collateralized over our entire fund and our entire portfolio that we have out on the street. So the second pillar is origination, meaning we got to go out, originate loans. How to do that? We're going to go into that in a second. The third is that once we have found a loan, a borrower that wants to use Rehab Wallet for their borrowing needs, somebody's got to process it, right? Everybody knows, everybody here has gotten a loan before. So somebody there is calling you and saying, hey, I need your proof of insurance. I need your driver's license. I need all kinds of things, right? That's our processor that's doing that. I see some people that's chatting and raising hands. I'm going to answer these questions at the end of this. Okay. I'm going to give plenty of time for us to do that, which is great. So please, if you got any questions, just drop them in the chat and I'm going to answer them at the end. After we've processed the loan and we've closed it, we got to go service it, right? We got to go collect payments. And last but not least, we have a compliance side of our business, which is the fifth pillar. You know, sometimes you got to go chase the money, right? If somebody has insufficient funds, our compliance department deals with a lot with that and ensuring we're in compliance. So let's go into detail, please, on origination on each one of these pillars. We talked about the debt fund, how to raise the money. We're out there constantly raising money to our debt fund. Now, you guys that are raising money for multifamily, it is a great lead in if you already have an investor base for your multifamily deals, because they are investors that can't and don't want their money tied up for 5 to 7 years. Our investor relation team now has a lending alternative asset class that we're in our debt fund that we say, okay, well, if you can't, investor A, if you can't tie your money up for 5 to 7 years, I totally understand. But we have a debt fund that's a liquidity fund. It has a 90-day liquidity option. You can get your money in, put your money in, and put your money out. So it's not tied up for that 5 to 7 years. So our debt fund, number one, raising the money allows us to get started. The second, now we got to originate loans to actually use this debt fund. What we're going to use this debt fund for is for the lending piece. So on the origination side, you have to be a good marketer. You know, we use social media. We use passiveinvesting.com's marketing department, which is phenomenal. Again, we're working together. Rehab Wallet, our fund, and passive investing, we're partners in this, right? So we're marketing consistently on social media. We're sponsoring events. We have booths. We have we want to prepare tables when we go to these events that has Rehab Wallet marketing and branding, as well as everybody that's there is in the Rehab Wallet swag. The networking piece of it. We're constantly in real estate investment groups all over the areas that we lend. We lend in the Carolinas and Georgia's predominantly. So we're trying to find real estate investor groups, associations. They're RIAs, they're called REIA for real estate investor associations. They're all over the Carolinas and Georgia. So we want to sponsor those events. We want to sponsor those groups and be present. Last but not least, we want to speak. We want to be on podcasts and webinars and stages. I want to be out there telling everybody about Rehab Wallet and what we can do. We can do transactional loans. We can do short-term fix and flip loans. We can do really soon, we're going to be able to do some long-term lending arms, long-term lending programs. But we got to be out there letting people know what Rehab Wallet does. That's what origination does. You might have went into a bank before and heard that a loan officer or a loan originator or an LO. That's what origination does. Second, well, before I do that, this is our term sheet. After we originate a deal, meaning a borrower has come to us, has come on our website or came to us personally through email and said, hey, I want to borrow $120,000 from Rehab Wallet. They go to our website, fill out the information. If we like the deal, we'll send this out. We'll send this term sheet out. Our originator, our director of sales, sends this term sheet out. This is our commitment to lend. It is crystal clear to a borrower what it is that we will lend and our terms that we will lend on. It gives the exact monthly payment. It gives the exact down payment that they need. Our LTV fits in our guidelines. Our guidelines are 70% or less LTV. Because again, we want to make sure we're only in good loans to protect our investors. We want to be good stewards of our investors, of our debt fund. So we send this term sheet out via DocuSign. If they sign it and send it back to us, it goes directly to our processing team. Now our processor knows that we have an active loan. They've paid a commitment fee of $500. Just went blank. $500, yes. And then it goes into our processing department, and we're getting them to the closing table. That's our processor's objective, is to get us and the borrower to the closing table on time. I think on our long-term sheet, I'm going to go back to that for a second. Our closing date here was, in this example, October the 11th. That's what the processor knows. And that's where we're committing that we can close and have the money prepared and all the documents prepared prior to that time. They're the behind the scenes type of person. They're super detailed. They're dotting our I's and crossing the T's. They're getting all the documents needed from our borrowers. You know, the scope of work for the rehab, attorney information, insurance, making sure that you as the lender is the mortgagee, so that if something happens with that insurance, Rehab Wallet, we're on the check with the claim, not just the borrower. They work with the law office and the title company to prepare all the title information. They're the behind the scenes. They prepare the mortgage, the deed of trust, the promissory note. They're the person that's putting all that information in and sending it to the attorney. Next pillar is servicing. Listen, we got to collect payments, right? And we love, again, in our example back then, we're at 15+% interest APR. That's with fees. But our term sheet, and we'll go back to it real quick. Our term sheet is at 12.75% interest only. So we're collecting those payments in the servicing department. We draft them on the 1st of every month. We pull from their checking account. And, sometimes they're late payments, sometimes they're insufficient funds. That'll move over to our compliance department. So, we have a director of compliance and a director of operations and a director of sales. So somebody is responsible for each one of these departments. But the borrower's paid off a loan. Once it's paid off, it doesn't mean it's over, right? We have to close out a file. We have to save the file. We have to satisfy the mortgage for, if Rehab Wallet has a loan out for that $120,000, we have to satisfy it, saying it's been paid in full. It's a document that has to be done. So once the loan is done, it's not finished, right? We have to save our files for 2.5 years or 2 to 5 years and move that way. There was one thing that I missed right here on maybe on the servicing side, and that's draws. So in our example up here, we have to ensure that we collect, we're not only giving the loan amount to purchase it, but we're also giving them the loan or the money to rehab it. Okay. So the rehab is sent out in draws. They submit a draw request that we put together, send pictures or videos, and we work off that way. So our 5 pillars have now been completed in our lending arm of passiveinvesting.com. Now listen, I'm going to go real quick to hit some chat or some Q&A and to see if I'm going to jump into chat for a second. Let me go into Q&A real quick. What kind of tax reporting is there? Do I pay at my marginal tax rate? Yes. I mean, again, I'm going to give you that normal, I'm not an accountant sentence, but, you know, it'll be interest coming into you as a private lender. And, you know, you have to pay taxes on that interest that you made over and beyond your basis of the loan that you put out. Todd's saying real estate deals come up and often close within 90 days. What is the average time within the 90 days to get my money out of the debt fund to invest outside deals? So that's a great question. The debt fund, we do offer that liquidity option of 90 days. We're super quick to get our investors' money out if they put a request in. Somewhere between 2 and 6 weeks, I would say. I don't know that we've ever held, investors' requests for more than 2 months. We try to, again, you got to think about this, okay? Think about us as a lender and as a business in whole. Debt fund is talking to the the lending arm, which is us. We're constantly talking. There's deals closing out today and getting paid off. And there's deals that's starting today and that's getting put on the street today. So that's what we call recycle money. So there's money being recycled constantly, daily, hourly, as well as new money coming in and investor money wanting out. So it is a balancing act between the lending arm and the debt fund and our accounting team at passiveinvesting.com. So it is a effort. It is a team effort that has to be balanced. And if I had to say, that's probably one of the hardest things that we do, but we get it done. And if it were easy, everybody would do it. But to answer your question, we get the investors' money back out. It's a simple email. I have personal money in our fund, a lot. Every partner has. So if I needed some money out of it, I just like everybody else, I would email Andrew or email the investor relation team or servicing team and say, hey, I would like to get $100,000 out. I need to go pay taxes. I have a wedding to pay for. I have things that come up in life. And then immediately we're constantly in communication on how fast we can get it out. Okay. Another question from Joseph. What is the split of the fees to the investors, i.e. of the 15% collected from the loan proceeds? Our investors, again, remember I said that we have now a tier. The more money you put in our fund, the more money you can make. So, but typically it's 6% paid out to our investors. So that's the split. There will be a different split if somebody brought in, it doesn't happen a lot. Somebody doesn't walk in with $2 million and say, hey, let's put it in our debt fund. But if they did, I believe our tier, and I'm sorry, I don't know that, but I believe our tier is at 8%. So if you put in up to, it's tiered. So if you put in 500 and above, it goes up from 6 to 6.5, and then it goes tiers up all the way up to 8%. And I get you in touch with the investor relation team. But the split is literally 6. It's a consistent 6% paid out to our investors. The other part, again, okay, listen, if you're in this example, Joseph, 15%, and we pay out 6% to our investors, that delta in between these two, that's where we pay our team, our payroll expenses, and anything left, obviously, goes back out to the GPs. These are fairly high interest loans. Why do people come to you for these loans? Less than stellar credit. How do you vet borrowers? What's your default rate? It is fairly high. Well, I think I used to think that, but I think Wells Fargo rates, now the 10-year treasury has come down the last couple of days when we all know what's been going on with these bank failures. But, Wells Fargo 20% down was in the sevens. A conventional interest rate is in the sevens. So, they're coming to us because of two things. One, we work with 99% of our investors, 99.5% of our investors. We can close fast and we have low documentation. We don't pull credit. That's not something that we're an asset-based lender. I told you at the beginning that I flipped for 18 years. Most of my team has all flipped. We take a look at the loan coming in and say, you know what happens if that person doesn't pay and I had to default? Would I like that in my portfolio? That's the way I look at it. It's 70% LTV, guys. So their investors, we close super fast. I mean, where else can you close in 24 hours, 48 hours? There's no bank will close that fast. As long as we have title work, we can close super fast. And our investors know that. Over 80% of our borrowers are return borrowers. And we've done, in 3 years, Rehab Wallet's been in business for over 3 years. And we're knocking the door down at 200 million in loans done this way. We vet borrowers by experience. Now we're not going to lend to new borrowers, flippers or investors that's just getting started. It's not going to happen. But we're going to vet them and experience. Our default rate, 3 years. I told you the numbers here at almost 200 million. We've had one default. And in that default was last month. And we were able to actually foreclose on it, then turn it right back around, put it on the market, and then we made money on the deal. And so I actually made money on it. I could actually give you the numbers, but it was a good turn. Now, why the investor didn't just put it back on the market, I don't know. I wish I knew that. Okay, let's keep rolling. So the fund keeps 7 to 9%. Yeah, pays out 7 to 9%. Back up, 6 to 8%. If you're at 1 million, if you bring in 1 million to our fund, we'll pay you 7%. And the distributions are paid monthly. If you bring in 2 million, it's 7.5%. If you bring in 4 million, it's 8% that we'll pay. What is the maximum loan amount that you will lend on one deal? Again, we love being nimble, and I love not having an exact answer to all these questions because we're nimble. We can do whatever we want. However, our PPM does state that we don't want any one borrower to have more than 10% of our fund. So our fund is changing every day, and we will never even get close to that 10%. I don't want that. If one investor, decides not to do his or her job, or listen, life happens, they pass away, something happens, and this deal does not go as expected. We want to make sure we don't have, that our fund is not exposed to one person. But we've done a $4 million loan, but our fund, it well exceeded, it stayed into the guidelines of our PPM to our investors. But we did that to a first lien position. And back up, our debt is always first lien position, no second lien positions, and all done in an entity's name. So we're always first lien position. And that LTV on that, it was a small multifamily. And it was, I'm thinking about the LTV. I believe it was less than 50% or right at 50% LTV. Okay, somewhere around that, low LTV. And I know the operators, I know them very well. and they have a team behind us. If something happened to that one operator, it wouldn't hurt the progress. So I felt very good lending out that. Doesn't happen a lot, you know, but we're fixing flippers. Our average loan amount is less than $200,000, guys. We do a lot of loans, $200,000 at a time. Can you speak to your risk management strategy? Our risk management strategy, I feel like, is within our compliance department. You know, we're going to stay below 70% LTV. We have somebody constantly overseeing to ensure the insurances are in place with our borrowers, that our taxes have been paid on properties, that our loans are, that our payments have been made on a monthly basis. But our risk management stays with here, that we only lend to experienced borrowers, 70% or less. We're in the areas that we really know. You probably can hear my accent, right? You can tell I'm a Southern girl. Our whole team is pretty Southern. We know the Carolinas and Georgia very well. I don't understand the climate in Denver, Colorado. I don't understand the collateral over there. We don't have to go over there, right? So we're comfortable being in this east of the Mississippi, staying Southern, staying in the Sun Belt, looking at states. Florida, for example, has a loan foreclosure process. I make sure that we don't have a lot of exposure in Florida, right? You have to understand that and treat this like a business and know each state that you're going to be in. Each state has different paperwork, right? South Carolina is a mortgage state. My processor knows all this. Georgia, some states might be a deed of trust states. You have to look into that. So that's a little bit about our risk management strategy. We reduced when the market started changing about 3 months ago, fall of 2022, we reduced our LTV from 75% to 70%, to VIPs, to everyone. We want to make sure that, again, our job is to be stewards of our debt fund. We're taking care of our investors, and that is my job every day. I have to make decisions. Our leadership team has to make decisions that's going to take care of our investors. Number one, make money later, but number one, taking care of our investors. All right. I think that answered everybody's questions. I want to, how long has the fund been in existence? The fund's been in existence for 3 years, 3 years, June. Okay. Had some other questions in this little area here, webinar chat. How many loans does your portfolio carry on average at one time? I think we're in the 400, high 300s of actual loans. I don't have that exact number. But last year we did 96 million in loans. The year before that we did 51 million. And this year our goal is 125 million in active loans. So it's at 200,000 at a time. I can't tell you right now, but it's 300 to 400, which means our investors, our debt fund is collateralized over all those loans. It's not dependent on one investor. All right, let's finish this thing up. Guys, I think we're close to this 30-minute mark. I appreciate everybody's questions. I want to remind everybody about the MFIN, which is June the 12th to the 14th. My team, Rehab Wallet, will have a booth alongside PassiveInvesting.com's booth. We'll be in there. If anybody ever has a question about this lending arm and wants to start a lending arm, please come find us. In that one room where all of the actually vendors will be. Remember, you have a discount code of $100, and that discount code, Kelli, dropped in the chat. Guys, thank you so much for your time today. If you guys have any questions, you're free to email me at Kelli, Kelli, @rehabwallet.com. Come visit us at our booth there at the MFI InCon in June 12th through 14th. All right. Actually, I'm getting a number actually right now for some of you that might want to know. It's we have 238 current loans out right now. So I hope that helped answer all your questions. Okay, guys, thank you so much, and we'll talk to you soon. Bye.